Walmart, the company with over 10,000 stores and 240 million customers per week, just surprised the market. While many thought traditional retail was slowing down, Walmart proved it's not just surviving, it's evolving. But how? And should you care as an investor? In this video, we're going deep into Walmart's first quarter 2026 earnings, breaking down the numbers, the strategy, and what it all means for the future of retail. We'll explore what's working, what isn't, and whether Walmart stock deserves a place in your portfolio. Let's start with the top line numbers. Walmart reported $161.5 billion in revenue, up 6% year over year, beating analyst expectations. Operating income was $7.1 billion, up 9%, signaling strong operational efficiency. EPS was 60 cents adjusted, up 10% and ahead of estimates. Same-store sales in the U.S. rose 4%, driven by increased foot traffic and larger basket sizes. And e-commerce? That's where the real story begins. Walmart's U.S. e-commerce sales soared 22% year over year. That's not a fluke. It's the result of years of investment in fulfillment centers, in-store pickup, last-mile delivery, and a growing marketplace model. CEO Doug McMillon put it this way: "We're not just growing online, we're building a digital ecosystem that amplifies our stores." They're effectively turning each Walmart location into a hybrid logistics hub, helping them compete with Amazon in ways Target, Costco, and Kroger can't. This hybrid approach is paying off, and they're doubling down on it. Another standout? Walmart Plus, their answer to Amazon Prime, saw a 28% increase in membership year over year. While they haven't disclosed the total number of paid subscribers, estimates suggest it's over 30 million. But here's where it gets interesting. Walmart's advertising business grew by 26%, with international ad revenue up 50%. This is a high-margin business, like Amazon's AWS Lite for ads. The more people shop online, the more ad inventory they can sell to brands. It's not just about groceries and clothes anymore. It's about data, eyeballs, and platform economics. One of the concerns last year was inventory bloat. That's been resolved. Inventory levels dropped by 2.7%, even as sales grew, signaling leaner operations and better forecasting. Walmart also revealed interesting consumer trends. Shoppers are buying more private label products, eating at home more, and prioritizing value. This benefits Walmart's low price positioning, but also highlights continued pressure on the lower income consumer. So while Walmart's gaining market share, it's partly because people are trading down from higher end stores. Walmart International, especially Mexico, India, and Chile, performed strongly, growing revenue 6.3% year over year. Flipkart in India is expanding its footprint, and PhonePe, their fintech arm, is seeing rapid adoption with over 500 million registered users. The international segment used to be a drag. Now it's quietly becoming a long-term growth lever, especially in markets where digital penetration is still in the early innings. Margins are where Walmart typically lags, so this quarter's strength matters. Operating margin was 4.4%, improved due to better supply chain efficiency and higher margin ad revenue. Gross margin was stable at 24.5%. Nothing extraordinary here, but it's the consistency that's powerful. Walmart isn't about explosive growth. It's about reliable, scaled efficiency that generates tons of free cash flow. Speaking of which, Walmart generated $5.7 billion in free cash flow this quarter. What are they doing with it? Increasing capital expenditures to expand automation and fulfillment, boosting their dividend. Walmart raised its annual dividend for the 51st consecutive year. They bought back $1.1 billion in stock during the quarter. This is shareholder-friendly behavior, but it also signals confidence in long-term stability and earnings growth. Walmart raised its full-year guidance, expecting revenue growth of 3 to 4%, operating income growth of 4 to 6%, continued strength in e-commerce and advertising. Doug McMillon emphasized that they're building for the long term, not chasing short-term hype. That's a rare mindset in today's market. Here are some key points to be mindful about as a Walmart investor. Inflation may be cooling, but pressures on middle and low-income consumers are real. If spending slows, Walmart may feel it. Even with ad revenue, Walmart's margins remain modest. One bad quarter of cost spikes could hit earnings hard. Emerging markets offer upside, but they're also volatile. Despite gains, Walmart is still far behind Amazon in terms of e-commerce infrastructure and cloud capabilities. So while the strategy looks good, execution must remain flawless. Here's why bulls love Walmart right now. Walmart holds up in recessions and now has real growth levers via e-commerce and ads. It has 4,600 US stores. No one else can replicate this footprint. From in-store pickup to same-day delivery, Walmart is becoming a tech-enabled retailer. It has decades of consistent dividends, scale, and adaptability. And perhaps most importantly, Walmart is not flashy, but it's reliable. And in a volatile market, that has value. Now here's my personal take. Walmart is doing what few companies can do, transitioning from a legacy retailer into a digitally powered ecosystem. The combination of physical presence, growing online sales, rising ad revenue, and membership stickiness gives them multiple ways to win. At the time of this video, Walmart trades at about 26 times forward earnings. Not cheap, but not unreasonable for a company growing at 6 to 8% with strong cash flow and a wide moat. If you're looking for a safe, steady compounder with optionality, Walmart belongs on your watch list. I personally view Walmart as a core portfolio stock, not because it will double in a year, but because it will likely be stronger 5 or 10 years from now, paying a growing dividend and outlasting weaker competitors. That's the kind of durability I'm willing to bet on. Walmart's first quarter 2026 earnings show a company that's not just defending its turf, it's expanding it. It's not sexy, it's not explosive, but it's one of the most resilient businesses in America, and increasingly a global retail tech player. So the question for investors isn't whether Walmart is exciting, it's whether you want exposure to a business that thrives in both bull and bear markets. If you found this breakdown helpful, don't forget to like the video, subscribe to the channel, and leave a comment with your thoughts on Walmart stock. Are you buying, holding, or staying away? Thanks for watching, and remember, investing is a marathon, not a sprint.